Equity Market Update, November 2019. In November 2019, Indian equity markets appreciated by approximately 2%, driven by optimism around the trade deal between US and China, buoyant FII flows, and announcement of measures for the real estate sector by the government. For the month, large caps outperformed small caps, but underperformed mid caps. Sectoral performance was mixed, with banks and metals outperforming while auto, capital goods, FMCG, power, oil and gas, and IT underperforming. Globally, equity markets fared well in November 2019. Major indices in the US, Europe, and Asia, except China and Hong Kong, delivered positive returns. During the month, Brent crude prices increased by approximately 4% and closed at $62 per barrel. Prices of zinc and lead fell, while crude and steel prices witnessed an uptick. INR depreciated by 1.1% against the USD and closed at 71.7. Following net inflows of $1.7 billion in October 2019, FPIs remained net buyers in the month and bought equity of $3.5 billion in November 2019. Total FPIs equity inflows in 8 months of FY20 have been $6.6 billion, as against outflow of $7 billion during the corresponding period last year. Net inflows in domestic equity-oriented mutual funds were INR 4,891 crores in October 2019, compared to INR 4,536 crores a month ago. For FYTD20 till October 2019, total flows in domestic equity-oriented mutual funds stood at INR 38,323 crores. Q2 FY20 results of telecom and corporate banks were better than expectations, whereas retail banks, cement, consumer staples, industrials and utilities were largely in line with expectations. Results for oil and gas, information technology, consumer discretionary were below expectations. As on 30th November 2019, Nifty 50 is trading at price-to-earnings multiple of 22.6x based on FY20 estimated earnings and 17.8x based on FY21 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. While discretionary consumption has slowed down, it directly impacts stocks whose weightage in Nifty 50 is less than 15%. Markets thus hold promise over the medium to long term in our opinion. With the sharp decline in mid-cap and small-cap stocks since the beginning of 2018, significant divergence with large caps is not likely going forward. It is worth noting that the gap between 10-year G-Sec and 1-year forward Nifty 50 earning yield has reduced significantly, and it is now below the 10-year average. This indicates that equity markets are attractively priced. In view of the above and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual fund flows, delays in NPA resolution under NCLT are key risks in the near term. Debt Market Update, November 2019. The 10-year benchmark G-Sec yield ended the month of November 2019 at 6.47%, up 2 basis points over the previous month end. Average interbanking liquidity continued to remain in surplus for the month due to higher central government spending, forex purchases by RBI, softening in credit growth vis-à-vis deposit growth, and moderation in growth of currency in circulation. Corporate credit spread over G-Sec yields contracted sharply by approximately 16 basis points during the month. Net FII debt flows were negative for the month at $0.3 billion compared to net inflows of $0.5 billion in October 2019. In the first 8 months of FY20, aggregate net FII debt inflows stood at $3.7 billion as against net outflows of $7.5 billion in the corresponding period a year ago. INR depreciated against USD during the month by 1.1% and ended the month at 71.74. Annual rate of retail inflation CPI rose further to 4.62% in October 2019, up 63 basis points month-on-month, after rising 72 basis points last month. The increase was largely due to significant increase in food inflation, which increased to 6.93% from 4.7% a month ago. The sharp rise in prices of vegetables, especially onions, is on account of unseasonal rainfall in key states like Maharashtra, Karnataka, and Gujarat. The rise in food inflation was partially offset by lower core CPI. The fall in core CPI was driven by fall in rural education and healthcare inflation, mainly due to base effect. India's gross domestic product growth declined further to 4.5% year-on-year in Q2 FY20 from 5% in Q1 FY20, led by weak investments growth. Private consumption, though improved compared to a quarter ago, remained benign. Growth in exports was also weak, but was set off by weak imports. Growth in gross value added also slowed to 4.3% year-on-year in Q2 FY20 from 4.9% a quarter ago, primarily led by slowdown in industry, especially in the manufacturing segment, which contracted by 1% year-on-year. Fiscal deficit for FYTD October 2019 stood at approximately 102% of FY20 budgeted estimates, slightly lower than approximately 104% during the same period last year. Growth in gross revenue remains muted at 1.2%, with direct tax collections growing at 3.5% and indirect tax collections falling by approximately 1%. Over the past few months, the government has stepped up expenditure, which has resulted in FYTD fiscal deficit widening to 3.6% of GDP from 2.8% 3 months ago. Fiscal deficit has remained within reasonable range despite weak revenue growth, mainly on account of higher RBI dividend. With recently announced corporate tax rate cut, direct tax collections might moderate further, and thus risk of fiscal slippage remains high. In a surprise move, the Monetary Policy Committee in its December 2019 meeting unanimously voted in favor of keeping the policy repo rate unchanged at 5.15%. Further, it also voted in favor of maintaining an accommodative stance. The reverse repo rate and cash reserve ratio remains unchanged at 4.9% and 4% respectively. RBI also revised its near-term inflation forecast to over 4% and now expects it to come below 4% only by Q2 FY21. It also revised down its GDP estimate for FY20 to 5% from earlier estimate of 6.1%. Outlook. The Monetary Policy Committee's decision to maintain the policy rate was against the consensus expectations of 25 basis points rate cut. RBI is maintaining an accommodative stance as long as it is necessary to revive growth while ensuring that inflation remains within the target was in line with expectations. Since February 2019, RBI has reduced the policy rate by 135 basis points in aggregate, though the transmission has been muted in bank lending rates. Given that RBI is expecting inflation to be below target only after 6 months and the possibility of growth bottoming, Any future rate action by RBI is likely to be data dependent. G-Sec yields rose by around 15 basis points on unanticipated pause by RBI and dampening of hope of more rate cuts in the near term. With regard to yields at the longer end, as we have been highlighting, opposing forces are at play. Easing stance of major global central banks, ample interbanking liquidity, steepness of the yield curve and weak credit growth favor lower yields. On the other hand, risk of fiscal slippage, excess statutory liquidity ratio investments within the banking system, high near-term headline inflation, possible bottoming out of growth, etc. are likely to impact yields adversely. In view of the above, yields at the longer end of the curve are likely to trade within a range. Considering the aforesaid factors, in our assessment, the short to medium end of the yield curve offers better risk-adjusted returns. Hence, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.